Welcome everyone to episode 29 of the Sloth Investor podcast, 2023. Jay, we finally made it. How are you?
I'm doing fantastic. Actually, the funny thing is the number of our podcast actually is the same number of how as my age, how many years I've been on this planet. I'm
What do you
29.
Congratulations. You haven't even reached a ripe old age of 30. Jay, what can I say? You astound me. You astound me with these
Yeah, I
facts. It's
know.
incredible.
Exactly. It's amazing how old I look when I'm only 29 years old.
It's incredible. It's incredible. Jay, you're looking pretty sartorially elegant. Should I say right now? You're looking pretty swish. In honor of anything, do we have anything coming up in this corner of the world?
Well, for those of you who are living in Asia, you will know that Chinese New Year is a very big event. For the people who are maybe a little more towards Europe or towards Canada, towards the United States, Chinese New Year is our Christmas, and it's a huge, massive celebration here. And the traditional clothing tends to be a bright red in color, and for celebration. And I won't try and make myself look foolish by going to the little bit of the history, but what I do try and do is take part of the festivities by wearing the traditional colors. And you can see here, if you can look real closely, I have some what I think to be some absolutely fantastic looking Chinese New Year attire.
Indeed, fantastic attire. I mean, what more could you want than fantastic attire during Chinese New Year? Jay, what can I say?
And equally so, I can't help but appreciate the clothing you're wearing. For anybody who might be tuning in for the first time here, what's the deal here? What is this? What's going on here?
It's the Humble Sloth, and I think it's now making its third appearance within our podcast series in terms of the shirt. We've got Mr. Sloth back here as well, and this really ties in well to the theme of our podcast today, because Jay, what we're hoping to do is to really distill the 5 bedrock principles of the Sloth Investor, particularly for our newer viewers, because we used to predominantly, release the podcast episodes on Spotify, and we took a decision in 2022 to kind of branch out, to begin to move on to YouTube. And since doing so, we've had so many great guests: Eric Balchunas, the author of The Bogo Effect; Nikki Dunn; Brian Feroldi from the Motley Fool; most recently Andrew Hallam, our Christmas special. Andrew, obviously the author of Millionaire Teacher, Millionaire Expat. And this is our first YouTube podcast episode of 2023. And I think really the two of us, we want to kind of communicate to people why the humble sloth is the best animal to characterize successful investing. Because even for the layman, I think many people know that, what are the two animals that we typically associate with the stock market? It's the bull and the bear. But I think as this podcast episode kind of runs its course, people will begin to see why the sloth really is the most essential animal to characterize successful investing.
And it's what I love about sort of this philosophy is that the words in sloth, actually you've developed an acronym for it. It stands for something. Do you want to go into a little bit more detail for people who might be tuning into your YouTube channel for the first time? Why sloth? Why the Sloth Investor?
Yeah, absolutely. Okay, so we've got our 5 bedrock principles. Okay, so first of all, we have simplicity, and then low fees, then owning the world, time, and headstrong. And throughout this episode, I'm going to, with you, break down each of those principles, indicating why for us it's a key principle of being a successful investor, and ultimately the sloth. I mean, Jay, what do you know about sloths? What's your background knowledge?
The one thing I know about sloths is they are very slow. I've been accused of being a sloth myself.
Yeah, you're not the first one, you're not the first one. Jay, sloths are very inactive, and I think in most realms of life, what is it that brings us success? It's action, whether it is, learning a new skill, trying to revise for an exam, it's action. It's that competitive, the repetition again and again and again of action that brings us success. But that's one of the kind of fundamental paradoxes for me of investing, that less is more. It's inactivity that really helps to reap great rewards for investors around the world. So ultimately, for me, that's why the sloth is the most essential animal to characterize successful investing. So let me dive a little bit more into that first bedrock principle. Let's beginning with simplicity. So for me, many people are deterred by what they deem to be the complexity of investing. Because quite frankly, you and I both know people just don't learn about investing at school. Sadly, it doesn't seem to be within the curriculum. And I think there have been some inroads within certain countries. And I'm beginning to see concepts such as saving money and, debit cards and credit cards being introduced. But I just feel like investment literacy, really understanding the nuts and bolts of what to buy, the time horizon, that's still not really addressed enough within the school system. And so for many people, they see investment as being, full of jargon, perhaps, it's a numbers game and, I need to be good at maths. And this real sense that so many people have an imposter syndrome as well. What are your thoughts about that?
Yeah, and much like what you're describing here, I went through school thinking, oh, I'll never understand it. I need to hire an expert. I need to pay money to an expert to understand it because it's not something I could ever grasp. And it wasn't, unfortunately, until my 40s. I just revealed I'm not 29.
Had to come out of it.
It wasn't until my 40s that I actually developed an understanding, and to my embarrassment, it didn't require a whole lot of in-depth training. It required some reading for me to understand, but it was almost like a domino effect when that made sense, and that made sense, and that made sense. And again, much to my embarrassment, much to my regret, and much to the sadness of my bank account, I paid fees to people who I thought could do it without realizing that I could and should be in charge of my own money management, my own investment strategy.
Yeah, fun. Absolutely. And that's something I think we'll get onto in a moment as well. We look at the second bedrock principle, low fees, and why they're so significantly important. And Jay, for those of our listeners who are familiar with our, podcast series on Spotify, we would often end up having conversations about movies and making references to movies. I know you and I are both fans of Tarantino and gangster movies.
Yes.
And I can't help but think back to Heat. I think it's a 1995 Michael Mann movie starring Robert De Niro and Al Pacino and Tom Sizemore. So Tom Sizemore is an actor. His character, Michael, he utters the words, got them written down here. For me, the action is the juice. For me, the action is the juice. So he's a criminal, he gets off on these high octane, chases and, battles with law enforcement. For me, the action is the juice. Okay. And fundamentally, the point I want to make to our listeners, to our viewers on YouTube, is that sloth investors are completely different. Okay. We don't crave the action. We don't look to trade stocks on a daily basis. For us, inaction is our juice. Okay. So it's that complete opposite of Tom Sizemore's character, Michael. For us, inaction is the juice. It's all about less is more. It's all about patience and staying the course, as the late great Jack Bogle mentioned, which I'm sure we'll come on to in a moment as well.
And it comes down to I think making sure that you understand, and it touches on so many points, the sensationalism in the media about oh, you've got to buy this right now, you've got to sell this right now, and not getting caught up in that hype. Just keep it simple. You don't need to have this massively complicated and complex investment strategy. If people follow your advice and are sloth-like in their approach, it doesn't have to be a difficult, it doesn't have to be a challenge, it doesn't have to be something that's onerous. It's actually remarkably simple.
Exactly. I think Warren Buffett as well, most probably the most influential and well-known figure within the investing realm. He even talks about the fact that you don't need a high IQ to be a successful investor. It's about temperament, and that's something we'll get to a little later on when we explore Headstrong. But ultimately, it's not about IQ. And we're both bright guys, but we're not Einstein. But we don't need to have an IQ above 160 to be great investors. Absolutely not.
My son applies your strategy. My son applies your strategy for his own investments.
Absolutely. And that's where it's at. And that is music to my ears, because ultimately, we're trying to reach all ages, but particularly the younger generation who can really reap the rewards, the benefits of compound interest year upon year upon year. So that is music to my ears. That's fantastic. Really is.
So you were going to say something and I cut you off.
Yeah, that's fine. Jay, I want to circle back to low fees now, the second bedrock principle of the sloth investor. Okay, so really, it should naturally follow that a belief in simplicity, i.e. a less is more approach to investing, shouldn't require high fees. So this line of thinking is correct and it's logical. And again, I want to touch upon the fact that, we're so attuned to paying high fees for so many aspects of our life, whether it's to go and see a doctor, whether it's, paying high fees to a tutor. We are just conditioned to believe that the greater we pay, the higher quality the results will be. But within the realm of investing, that's not quite the case, is it? It really isn't. And we've come across this phrase before that Andrew Hallam has used. Would you like to kind of reveal it to us now? Snakes in. Do you want to tell it to us?
Snakes in suits, and this
Yeah.
is what the people who have heard our podcast before on Spotify will know that that's one of sort of my much to my chagrin, I fell for the snakes in suits.
Yeah, yeah. I mean, we've spoken before as well about these impression amplifiers. And having worked in the Middle East, I worked in the Middle East for several years, 5 years altogether with Mrs. Sloth, and the kids were born there as well. And the snakes in suits, unfortunately, are rife there. Okay, they tend to particularly prey upon young expats from the US, Canada, Australia, the UK, South Africa, and so on. And they prey upon young expats who don't particularly, have so much financial background, don't know how to invest. They're away from their home country for the first time, quite a bit of high disposable income. And these snakes in suits, with these impression amplifiers of smart suit, elegant and fancy company brochure, perhaps even, company car, they can't help but take advantage of these kind of young, impressionable young people who get sucked into kind of these investment schemes that really are not defined by simplicity; they're defined by complexity. So, we want to make
exactly it.
Yeah,
And I
yeah,
fell for it.
yeah, yeah.
And I was handed this big, thick booklet of his investment strategy, and I was like, "Oh, this is beyond me." Of course, he would just quickly brush through it. "Oh, don't worry about this. We'll worry about this. Just sign right here." And that should have been the red flag for me, right? That should have been the red flag.
Yeah.
But when I looked under the hood, and when I began to sort of discover what was going on, and I had someone help me look at the fees, it was 1.5% here, 2% here, another 0.7% here, and all of a sudden they were adding up to this massively significant chunk of fees, and it would left me with basically very little chance of being able to earn anything on my investment. So the question becomes for you in your mind, what would for our listeners, what would constitute a low fee in your mind?
Yeah. So when we touch upon owning world in a little while, our third bedrock principle, I'm going to talk about the particular kind of investment vehicles that you and I tend to advocate for beginner investors. But those vehicles, ideally, I would look to kind of ensure, I would encourage people to strongly ensure that they're paying a fee of, below 0.5%. Okay. And I'll touch upon actually an investment product, an ETF. Okay. And I'll talk more about this in a little while when we look at owning world. But an ETF that I regularly buy on a monthly basis has a fee of around about 0.22%. So ideally, I would ensure when I'm having a conversation with someone, particularly a beginner investor, that they're ensuring that the fees they're paying are, around about that, 0.2 to 0.5%, perhaps even lower, ideally. And Jay, you wanted to touch upon something else as well in terms of fees as well. Did you want to touch upon it now? Yeah.
So the fees that my fees range from you're gonna talk a little bit more about ETFs, but my fees range from I own one called MGK, and the fee on that is 0.07%, which is very, very low. I own another one called HXCN, which the fee is 0.05%. But I also own another one called QCLN, and it's towards the higher range of what I would want to pay, and it's coming in at around 0.58%.
Yeah.
So
sure.
it really depends what you're going after in some parts of the part. But I would say that 0.58% is towards the higher end of what I would be wanting to pay for a fee towards any kind of ETF.
Yeah. And Jay, I'm just wondering, let's say, even after having exhausted themselves watching every single episode of the Sloth Investor podcast and watching all of the content we create, there's still someone who thinks, you know what, I need my hand to be held a little bit more, and that's fine. I wonder,
Mm.
is there someone I could speak to? I just need that little bit of reassurance. What are your thoughts about this? We've briefly discussed this before on the podcast, haven't we?
Well, and Andrew Helen refers to them as fee-based advisors,
Yeah,
and
yeah,
the difference between a fee-based advisor and somebody who takes your money on a regular basis is the fee-based advisor takes a fee one time,
mm,
and I think you and I have used the same person.
yeah.
I've paid for a consultation. Did you pay for a consultation with the person I think you're going
Yeah,
to bring up?
yeah. We spoke to someone called Mark Zorrell. So when I moved to Hong Kong, I was looking to change my brokerage, and I was aware, having done a little bit of research, that the brokerage I was using in the Middle East was quite expensive in terms of fees. Again, wanted to really prioritize the fact that I wanted to pay a low amount of fees. So I was looking into a preferred brokerage, and I just wanted just a little bit of handholding to set the brokerage up. That's all I wanted. In terms of my overall philosophy, I knew what I wanted to buy, and I knew the importance of time, which we'll get to, but just in terms of setting the brokerage up. And it's a gentleman that you and I both spoken to called Mark Zoran. Perhaps what I'll do for the description to this video, when it's published on YouTube, I'll put a link to his website on there. We're in no way affiliated. We don't receive any commission, but I do know he's helped out a ton of people, particularly expats, just in terms of setting an investment account up. So he was
Yeah,
tremendously
it was
useful.
perfect for me because
Yeah,
I just did a Zoom with him before Zoom was a thing,
yeah,
and
yeah,
but
yeah.
I showed him my portfolio and he looked at it and he said, okay, you might want to consider this, you might want to consider this, you might want to go this, and this looks good. So it
Mm,
was actually you talk about hand holding for someone who might not be comfortable. Just having that someone, and I don't think the fee is overly onerous. I think what I paid
no.
about 100 US.
I paid about that, a one-off fee, and yeah, that was, yeah,
Yeah,
yeah. It's really good,
and that was
really good.
that made me much more comfortable in my approach.
Absolutely. Yes, that reassurance fee, isn't it? Yeah. So, Jay, owning the world. I mean, let's talk a little bit about this, because here is where I really get into nuts and bolts of what to own. And viewers, I brought along a few little props today. Okay, I've got my little crystal ball. Mrs. Sloth was quite surprised when I received my Amazon delivery 7 months ago with a crystal ball. She said, "What are you up to now? What is going on? Why on earth have you got a crystal ball? What is this all about?"
Why are you
This
bringing
is
this into my house?
I know, why is this in my house? What are you going to do? What witchcraft is Mr. Sloth? Let me explain. So, quite frankly, listeners, none of us possess a crystal ball in real life. Okay, I've got a little prop here, but sadly, none of us can forecast the future. Okay, and the point I'm trying to make is that, quite frankly, none of us know which country is going to really outperform in terms of, the next decade, the next 2 decades, 3 decades. Will it be the States? Will it be China, Japan? Hey, will it be one of countries from South America? Quite frankly, we don't know. Okay, and therefore it begs the question. Well, I'm a beginner investor and I'm a busy guy. Perhaps there's someone out there who's got a family, someone out there who likes to kind of, play golf, or someone who's a keen reader. People don't want to commit hours and hours and hours a year to investing. And we understand that. And this is ultimately something that we together have spoken about. So our key aim is to simplify investing for all. Okay. And this brings me to my second prop, Jay. It brings me to my second prop, which is the globe. Okay, so
Why would you bring a globe to this?
Why would I bring a globe to this? Why? Because, quite frankly, listeners, Jay and I don't know which country is going to outperform, whether it's the States, whether it's Canada, UK, Australia, we don't know. So our philosophy is to own the world. Okay, our philosophy is to own the world. And Jay, you and I, we're in good company here, because our very last podcast guest, okay, Andrew Hallam, author of books such as Millionaire Expat, Balance, and this great one, Millionaire Teacher. Okay, you and I know are both massive fans of this book. Andrew is a really firm advocate of owning a low-fee, globally diversified ETF. So basically, I'll get to that in a moment, what it is that I own in particular, but it's a fund that contains thousands of stocks across the countries of the world. And not only that, but it also is diversified across industries. Okay, so if you're thinking about 3 words beginning with S. So first of all, let's take stocks. Okay, within an ETF, within an index fund, you're going to get 3,000 to 4,000 stocks, sometimes even more. You're going to get diversification across sectors. That's my second S. So information technology, healthcare, utilities,
Banking,
banking,
finance.
finance. Like, thanks for helping out there, Jay. Yeah, banking, finance. At least 9, 10, 11, 12 industries. And my third S is states, nation states. Okay, so within a low fee, globally diversified ETF, you're going to get that diversification across stocks, across sectors, and nation states. Okay, and that ultimately is our advice to anybody that doesn't have a crystal ball. That's ultimately our advice. Okay, so in terms of the composition of an index fund, so it's weighted to the major economies of the world. So some might ask, well, the US has been a pretty strong country for the last 150 to 200 years. How much of my low fee index fund is going to be weighted towards the US? So it's typically in the region of kind of 50 to 60%. Then you're going to get weighting to the other major economies of the world, such as Canada, the UK, Japan, Australia. There's a weighting there towards emerging economies as well. And perhaps I might just circle back a bit actually to an index fund. It's something that we broadly covered a lot within our series, particularly on Spotify. But an index fund, this is something that Andrew Hallam mentions in Millionaire Teacher, but it's a great name because if we think about a non-fiction book, what do we find in an index? We find those keywords that are used throughout the book, okay? And an index fund, likewise, is made up of so many thousands of companies from around the world, okay? Just like that index we find within a non-fiction book, composed of so many different words, the index fund is composed of so many companies from around the world, healthcare companies, tech companies, utility companies, and so on, okay? So Hallam's in good company. There's a great book that I know we've touched upon here and there within the series, Investing Demystified by Lars Kroyer. We also have The Simple Path to Wealth by J.L. Collins. He's a big fan of index funds. Ben Carlson's A Wealth of Common Sense. And of course, I think it's now I may be mistaken, but I think it's now sold over 2 million copies. The Psychology of Money, Morgan Housel. This is a fantastic book, which we've spoken about. He's another big firm advocate of index funds as well. So, Jay, anything that you would like to add on index funds?
Well, and there's a reoccurring theme here. And I think that all the books, the books, is it fair to say that they can be summed up by your sloth-like approach, the S being simplicity, the L being low fees, the O being owning the world through an index fund or an ETF. There's a reoccurring theme here that I hope our listeners are catching, that these books, regardless, when it comes to investment strategy, you don't need to be paying some expert who takes a commission from you to do this for you. You can do this yourself.
Yeah, hands off. We've heard terms before such as couch potato, hands off, less is more, and that's ultimately what we're trying to preach here. I.e., that is why we have chosen the sloth, because it's the ultimate animal. It's inactive, and less is more. It's really critically key. And I want to circle back as well to one of our podcast guests. I believe it was from episode 28, Eric Balchunas, author of The Bogle Effect, and you can also find a review of the book on my YouTube channel. He asked Jack Bogle during his life. Sadly, Jack Bogle passed away 3 years ago, actually 3 years ago. I think it was yesterday, January 16th, 2019. He asked Jack Bogle, why is it? How comes, so many Vanguard investors, okay, and Vanguard is the company that Jack Bogle founded. Why are so many Vanguard investors able to behave in such a practical, common sense manner? And Bogle mentioned Eric Balchunas. It's because of this whole notion of relative predictability, i.e., it's quite predictable how an index fund is going to perform over time. Yes, some years, as we can see, over the last few years, there's going to be volatility, but generally over the course of history, you're going to expect to see an average return of around about 8 to 10%. And this is the fascinating thing that I know we discussed with Andrew Hallam on a previous episode. It's actually rare to get it in 1 year. 1 year, the stock market might go up 25%. The next year, 14%. The next year, -2%. But over time, it's an average of between 8 to 10%. So you've got that relative predictability of how the stock market is going to perform. And I think that's so critically key. It really is. Circling back to Bogle as well, there's this phrase that I think we actually used in our very first ever podcast. Wow, I think it was June 2021. Seems a while ago now, Jay. But again, it's by Jack Bogle. And this, for me, sums up the reason why it's critically key to kind of own the world and have that diversification. And it's, don't look for the needle, buy the haystack.
Yeah.
Don't look for the needle, buy the haystack. So many people are, looking to find that next Amazon, that next Apple, the next Netflix, and it's critically next Tesla, and it's so hard to do. I kind of refer to it as the Forrest Gump problem. I mean, are you a big fan of Tom Hanks, Jay?
Yeah.
Oh my God, absolutely.
Love the movie Big. I love the movie Big.
Big's incredible. And I think back to Forrest Gump. I think I'm not mistaken. Gump, I don't know how he gets it, but he's got this kind of position in Apple. He's got a position in Apple, and then he finds out many years later.
Company.
Yeah, and fruit company, of course. And he finds out it's worth so many millions of dollars. And we've all heard those stories about, geez, if only I'd bought Amazon in 1998 or Apple in 1980. And well, of course, we'd all love to go back in time, go into a time travel machine. But how likely is it that we're going to necessarily own the next Apple, next Amazon? So again, as Jack Bogle quite rightly says, don't look for the needle, buy the haystack. Just buy it all, own the world, get that global diversification. I don't have the book with me now, but I do. It's behind me here. Daniel Crosby, author of The Behavioral Investor, he talks about the fact that global diversification is so key, because how do we know the next major company, the next major kind of like consumer company might be in Brazil, might be in Mexico, might be in Finland, who knows? He talks a lot as well about behaviorally what investing globally does for us as investors as well. Okay, it gives us that diversification.
And I would say that equally so, if you do happen to find the next Tesla, well, we can see that they're not bulletproof. And some classic examples of Kodak. I don't know if our listeners who might be a bit younger are familiar with the company Kodak, but they used to be the premier. I remember when I was in high school learning that Kodak and Coca-Cola were the two most popular worldwide icons.
Yeah.
And now Kodak used to be synonymous with photography. Yeah. And now, does anybody ever talk about Kodak? They're at one point one of the best stocks in the world to own. BlackBerry, another good example, poor Canadian company. But at one point they were sort of the Cinderella story of the stock market, and now they're nowhere to be found. So there's a lot of value, in my opinion, on owning the world through an ETF or an index fund, because it gives you a hedge, rather than the stock jumping up and then potentially jumping back down. What we do know over time is that the stock market will go up.
Yeah. And Jay, just looking at your background, I'm reminded of something else as well. So it looks like an evening, a gorgeous skyline there, Hong Kong. We're filming this, we're actually recording this in the evening in Hong Kong. And for me as well, owning the world, okay, a globally diversified ETF index fund enables you to sleep better at night. So this approach is sometimes known as a swan approach, sleep well at night, because you can imagine for those people, perhaps you've crafted a portfolio of, relatively small portfolio of maybe 8 to 10, maybe 12 stocks that they're really confident in. All right, maybe those guys have done some research, those guys and girls have done some research, but how can they be entirely sure that the stocks they've chosen are ultimately going to outperform in the future? When you're purchasing, a globally diversified fund containing companies from around the world, across industries from around the world, I fundamentally agree. I fundamentally feel that it does enable you to sleep better at night, because you're not endlessly worrying about, have I bought the right stock? Have I bought the right stock in the right sector? How am I, allocated to the right country? So the kind of swan approach, sleep well at night, is something that really resonates with me as well.
It's probably the closest thing to a guarantee you can get.
Yeah. Mm-hmm.
But it really does that lead us into the next topic of time, because that's such an important aspect of your investment strategy.
Yeah. And Jay, it's interesting that a moment ago we actually spoke about, Amazon, Netflix, Apple. And these companies are great. We can't deny it. These have been the companies of the last 10 to 15 years, 20 years even. And there's one thing though, for me, there's a bit of a paradox here, because as much as these have been great companies to own, and these companies such as Amazon and Apple, they represent major elements, allocations of a low-fee, globally diversified ETF. I actually think these companies, Netflix and Amazon, for example, and even Uber, have conditioned us to immediate gratification. We're spoiled, aren't
Yeah.
we, Jay? We just think about, I'm thinking about my kids at Christmas time, Home Alone. I'm hoping that, Home Alone might be broadcast on TV on Christmas Eve. If it is, I hope the TV's free. My kids could just go into Netflix at Christmas, watch Home Alone anytime they
Uh,
wanted. And we've just become spoiled. Amazon, how do,
on demand.
on demand, how do most of us get our presents? It's via Amazon. Even in London, Christmas time, I wanted to get a last minute present for Mrs. Sloth. I literally was able to get it delivered to a pickup point close to where we're staying in our hotel. So we become spoiled. But the flip side of that is that I do wonder if this incessant need to get things immediately, the fact that we have, as contemporary consumers, been conditioned to immediate gratification, I do wonder what the downside is. And of course, you know what this is coming to, Jay, and I think many of our listeners will, the importance of patience. It's so critically key. It really is. And but why is that? I mean, why should someone not just have maybe, why should someone not expect to, get a great return over a 2-3 year time period, Jay? Why is that?
And there's probably no better example than what we're going through right now.
Yeah, yeah, yeah,
I had someone come up to me yesterday. I hadn't seen them in a long time, and it was funny because he was sort of having a mini go at me. He's like, "Oh, you tell, in your podcast, you tell people they should be buying stocks, but everything has gone down." Yep,
yeah,
it has,
yeah,
and actually, I don't think that's a bad thing.
yeah,
I personally view that as stocks on sale. It's
yeah,
when I go to a supermarket, and if something's on sale and it's something that I really like, well, what do? I stock up on it.
yeah,
And I've viewed this as the ETFs that I really like. This has been a sale.
yeah,
And had I only been into it for a year or 2 years, I would have sold, gotten out, and I would have lost money.
yeah,
But ironically, things have started to rebound the last month or so, I would say.
yeah, I'd say so. Yeah,
And
yeah,
it's I can see, and I'm someone who tracks my portfolio every month, once a month. On the 15th, I look at my portfolio where I am, and yeah, sure enough, it was going down, 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 and then now I can see it starting to climb back up. And
yeah,
this is a very normal behavior. This is very normal investment behavior. But
mm,
what's key here is I had to have believed in what I was doing,
mm.
um, to continue with my investment strategy to see it through the down period, to hopefully now we're going to maybe hit a strong run upwards now.
Yeah. And you make a key point there about you had to understand what your underlying philosophy was, because we spoke earlier about the fact that, you don't need to have an IQ above 160, even above 130 to be a great investor. But what I would argue, and I know Morgan Housel has argued this as well, is that ultimately psychology and an understanding of history is critically key. Okay, understanding the way the markets performed in the past is really, really important, and recognizing, again, going back to Morgan Housel, this great article that I know I've mentioned several times in a podcast before. He wrote an article called "The Tyranny of the Calendar." The tyranny of the calendar. And in this, he speaks about the fact that so many investors become preoccupied with the 1 year calendar return. Hey, what was the return in 2021? What was the return in 2022? When we don't need to worry about that 1 year return. We're more interested in, hey, what was the return perhaps over 1 decade, 2 decade? When you look at that long term, when you zoom out, okay, when you look at that long term time horizon, you'll see that average return of around about 8 to 10%. So don't overthink 1 year returns. Have that long-term time horizon. And the point I always want to make to people as well is just think about the goals you've achieved in your life. Whether it was mastering a musical instrument, perfecting your golf swing, perfecting your serve in tennis. Those things didn't come overnight. I know, certainly not for me. They take time. Likewise, when it comes to investing, it takes time. It really does. Someone who
And
you go ahead, Jay. Go
sorry.
ahead. No, go ahead.
Well, one of the things that Andrew Hellum says is not timing the market, but it's
Mm,
time in the market. And
absolutely. Yeah.
to me, no better example than what we've been going through.
Yeah.
I know I've mentioned this just 5 minutes ago, but had I abandoned everything because things were going down, then I would have missed out on those sale prices. And
Absolutely.
it just, I'm a big believer and a big advocate of just regular um, contributions. I try and make my contributions every month. Some months are bigger than others, but I'm always investing every month, um, regardless of price. And I'm just sort of coming back to my owning the world and my ETFs.
great advice. Whether you're using dollar cost averaging in the UK, pound cost averaging, whether in Europe, euro cost averaging, regularly on a monthly basis, committing to buying, a good amount of a low fee, globally diversified ETF or index fund. That's advice. That's been something that we preach from day one here at the Sloth Investor podcast. A really critically key, really is. I want to talk about something though, because we all know that our goals, we can have long-term goals, perhaps saving for a future fund. Perhaps I'll talk about that a little bit more in a moment, perhaps for retirement. But Jay, what are your thoughts about funds for the short term? I mean, let's say you're a parent, you're a mother or father, you've got kids who are about to go off to uni in 1 or 2 years, or perhaps you're saving for something special that's coming up within the next 18 months to 2 years. What are your thoughts then about investing a high amount of money in the stock market? Should you invest all your available capital in the stock market? What are your thoughts there?
Well, there's a sort of a thought process a way of thinking that it needs to be a bit more diversified, sort of a collection of maybe stocks, but also bonds,
Mm.
which are a little bit more of a guarantee, but the return tends not to be as high.
Mm.
But it really depends on where you are in your investment strategy. And
Yeah.
I've had people come to me and say, like, I need a winner. I
Oh,
need a winner.
yeah.
And
Mm.
I need something
Mm.
to turn around for me in the next year. Like you held up your crystal ball.
Yeah.
Nobody,
Mm.
nobody can do. And I've had people literally say that to me. I need a winner for the next year. Like it's impossible.
Mm.
Nobody can predict that. Nobody
Yeah.
can give you that promise. They can give you a guess, but
Yeah.
nobody can give you that promise. What are you thinking when
Exactly.
you ask me that question? What's in your mind?
Yeah, straight. For me, I just think what I would say to people, and I think I know this is something that Andrew Hams mentioned as well, particularly millionaire teachers. Just, I guess, just if there are any, short-term commitments coming up, whether it's a wedding, whether it's that round the world trip, whether it's sending the kids off to college, prioritize those funds that you need for the short term. So I would say money that you need in the short term over the next like 2 to 5 years. There's money that you definitely are going to need, capital you're going to need. I would say that should not be invested in the stock market, but at the same time, making sure that you've allocated money for that longer term goal, whether it's retirement, whether it's some type of future fund, whether it's that round the world trip with your partner in 20 years time. So I think it's just important to make sure that yes, you're always invested, you're staying the course, you've always got money invested in the stock market, but then making sure that if there are any funds that you need on a relatively short-term basis, that you're just being practical and making sure that you're taking wise actions with that money. That's I think something that Andrew Hammers mentioned as well. I'm kind of paraphrasing him a bit. I mean, their teacher, he's touched upon that as well.
Is it
Yeah.
fair sort of to say just be conscious of not overextending yourself with your investment strategy?
I think that's ultimately, you put it very well there. Yeah, don't overextend yourself with your investment strategy. That's very well put, definitely. I want to come back to as well someone that we mentioned early on in our podcast as well, and it's Grace Groner. Remember Grace Groner, Jay? Good old Grace.
No.
Let me mention Grace. So Grace Groner is someone who came to my attention via Morgan Housel. So yes, Morgan's written a great book called The Psychology of Money, but he wrote a fantastic article several years prior to this book called The Psychology of Money. And in that article, at the very beginning, he touches upon someone called Grace Groner. Now, Grace Groner is someone, no doubt, that many of our viewers may not have heard of, but Grace Groner was someone who was born in the early part of the 20th century. I think it's around about 1910. And Grace came from a very humble background. She never married. She wasn't born into wealth. Lived, I think, very modestly. I think in a 1-2 bedroom house at most. Worked at Abbott Laboratories, company in the US. But what she did was, after receiving her first paycheck, she invested her money on a monthly basis again and again and again. Okay, and this was from around about the 1930s. I think around about the mid 1930s, she got a job there as a secretary. Again, not a high-ranking person in a company, but a secretary. And she just committed to buying stocks on a regular basis. She held throughout the Second World War, throughout the Cold War, JFK's assassination, the oil crisis of the 70s, 9/11, you name it, any geopolitical crisis she held through. And lo and behold, when she passed away, I want to say around about 2005 to 10, I don't know exactly, but she left an estate of $7 million US.
Wow.
7 million US dollars. And the point I want to make here,
Crazy.
there is a little caveat which I'm going to get to as well. But the point I want to make is that she held through thick and thin. Okay.
Right.
You think about all of those tumultuous events that happened during her lifetime, particularly World War II, JFK's assassination, oil crisis, Black Monday, and I think it was 87, 89. She held through all that time. And again, that for me just demonstrates the importance of time. Now, I do want to touch upon now the caveat, something that I think you and I would agree upon is I really want to stress people should not do. Now, what Grace did was she actually had the majority of her holdings in one company, and that was Abbott Laboratories, the company that she worked for. Now, I would argue that she was tremendously lucky because would you and I
Yeah.
advocate investing in solely just one or two companies? Does that adhere to what
Yeah.
we would? Yeah,
Was it Andrew Hellum who said that I can't remember where I read it. If you're working for the company, your investment strategy will be diverted elsewhere
yeah,
because you it's a hedge. It's a
yeah,
hedge. If things are going well with the company, great. Hopefully they'll be going well with your investment strategy. If things go poorly with the company and you're invested with the company, then so goes your investment.
yeah.
And so as a wise investment strategy, people should tend to shy away. I can't remember who was it. I think it was Andrew Hillman who said that people should shy away from investing in their own company
Yeah.
as a hedge.
Yeah, good point. Good point. So I think the lesson to be taken from Grace there is that yes, ultimately invest for the long term over multiple decades. It's great, but please don't put all your eggs in one basket. Okay, don't look for the needle, as Jack Bogle would say. Buy the haystack. Okay, so important lessons. We need to inject a bit of nuance into that discussion about Grace Groner. I think we did that there, but yeah, certainly someone that you can learn from. If you look at that critical eye, Grace Groner. And before we move on to the fifth and final bedrock principle, Headstrong, I want to talk about the financial media as well. And, being in the UK over the Christmas period, I read, some broadsheet newspapers, and in the financial section, it's amazing how many times you come across the term trading. Brokerage apps, invariably, you'll see the term trading being used frequently. And naturally, trading leads to an increase in income for the brokerage because the more you trade, the more you pay in fees, greater their profits. So it's critically key though to remember that trading is geared towards the short term, short term ownership of stocks. We as stock investors hold stocks for the long term. Jay, any thoughts there about trading, about what I mentioned?
Well, and yeah, I want to touch on it when you talk about Headstrong.
Yeah,
I'm going to say what I want to
yeah,
say when you talk
yeah,
about Headstrong because to me
sure.
it applies to um, some life lessons I made. Had I remained headstrong, I could have avoided a lot of those mistakes. But
Yeah,
I hope our
yeah.
listeners will avoid that.
Yeah, sure. Well, let's move on to that fifth and final bedrock principle. And it ties in so nicely to that recognition of psychology. It really, really is critically key. So yes, it's important to understand market history, and we've kind of touched upon that, particularly when exploring time. But human psychology is key to successful investing. All right. So one certainty that I would say about investing is uncertainty. All right. So uncertainty is a certainty. You've got no idea the way the stock market is going to go. There's a great book I don't have here with me now by Howard Marks. He's written a book called Mastering the Market Cycle. And it's important to recognize that the stock market moves in a cyclical fashion. Okay. But again, going back to Jack Bogle and what Eric Balchunas has referenced in his book, The Bogle Effect, there is that relative predictability in the stock market. You know that there are going to be down years. At least 1 year of every four, there's going to be a down year. You're going to get a negative return on your portfolio. But 2 to 3 years out every four, generally, most years, I think it's something like 75% of years when I did my research about this, 75% of years you're going to get that positive return in the stock market as a whole. Okay. So in terms of being headstrong, I think we kicked off 2022, if I'm not mistaken, Jay, this time last year, with an episode about optimism. So optimism is key for me. But Jay, I'm going to move over to you now. Perhaps I can talk about optimism in a moment, but maybe if you want to touch upon optimism or make a point about headstrong too.
Yeah, you know what? I'm I'm very, I guess, I learned some valuable lessons, and one of the biggest valuable lessons, there was a major market correction in 1998 when I first started investing. I had an index fund. I had taken all my savings and put it in it, and then sure enough, couple months later, there was a major market correction. It seemed like a major market meltdown. And due to my lack of appreciation of a sloth-like approach to my investment strategy, I got scared. I read the headlines, the sensationalism, and I pulled out, sold everything at a loss. Had I not done that, had I just continued to invest, had I managed to avoid the media sensationalism, had I managed to ignore it and focus on my strategy of regular contributions without overextending myself and remaining headstrong in my investment strategy, I probably would be talking to you with this podcast from a nice sunny Cabana Beach, maybe somewhere in Bali, instead of here in my bedroom with a digital background.
Wait, you mean that's not your background? What?
I mean, this is my balcony.
Oh, I knew it. I know. Not bad for a 29-year-old. Not bad for a 29-year-old. I mean, Jay, it goes back to volatility, doesn't it? I think you and I can agree that is what puts so many people off, and I think the media is to blame here. Invariably, growing up as someone, in a family of, I grew up in a family with people that never invested. My mother, my late father never invested. Invariably, when any talk of finance or stock market was shown on news, it was because of volatility. We hear words like plunging. Stock market's down, say, flashing red neon lights. Okay, and then the alarm bells start to ring. And what happens to humans, what happened to me, certainly in my teens and early 20s, we associate the stock market with volatility, okay? And little did I know that, as Morgan Housel states in Psychology of Money, volatility is a natural feature. It's a price of entry, as to paraphrase him. It's the price of admission, okay? It really is. It's a natural feature of the investing landscape. And I want to talk about Benjamin Graham. So Benjamin Graham was someone who was a key influence upon Warren Buffett. And Graham came up with this analogy of Mr. Market. Mr. Market being someone who's kind of a bit of a Jekyll and Hyde character, kind of, irrational. You're not sure what his mood is going to be like from one day to next. Really exuberant one day, quite downcast next day. And I think that's a really key analogy for people, and particularly beginning investors, to recognize that, some days the market will go up, some days it will go down. Some years it'll be up, some years it'll be down. I think in an early episode, I refer to the temperamental toddler. You and I are both fathers, Jay. And I know in that toddler phase, they seem so irrational. What? You're upset because of what? Because, your brother didn't share this, or because, you didn't get your particular letters in alphabet soup. I mean, just crazy. The things that they'll kind of like lose their temper about. So I would refer to the market as the temperamental toddler. It seems irrational. You don't know how it's going to behave from one day to next, but it's critically key for people to remember that. It really is. Really is.
It is. Sorry, I cut you off.
No, go ahead. No, I finished, Jay. Go ahead. Yeah.
Had I not learned those lessons from 98 and even more recently, like, getting scared, even a decade ago, I would have sold. I would have sold during this downturn. I would have made, to me, that would have been a huge mistake, because now that things are going up, and I have friends who remain headstrong in their investment strategy, and then they pounced on the idea. I've got a friend, Rob, who's like, what, this is great. This is awesome. I'm going all in, chips in. This is a great opportunity. And now he looks like an absolute genius, because things the last month or so. Now it's impossible for me to say, are things going up, but good for him, because he recognized it, he perceives it as an opportunity to get things at a discount, at a much better valuation. So that ability to remain headstrong and ignore the headlines, ignore the sensationalism. The world is going into a recession. Like, a recession, oh my gosh, I gotta sell everything now. If you've not, as you mentioned earlier, not over leveraged yourself, and you don't need the money, let it ride.
Yeah, absolutely. Jay, I can't believe we've done this. I mean, we do it in most episodes, but we haven't made a reference to Tarantino. But I got one, Jay. I've got one.
Okay, I hear it.
So, regular listeners will know that we're big fans of Tarantino. New listeners, I got to repeat again, we're big fans of Quentin Tarantino, okay? And Jay, I want to talk about the fact that in terms of being headstrong, it seems that many people require a stunt double. And Jay, you've seen Once Upon a Time in America, right? Once Upon a
Yes.
Time in America. Yeah, this came out several
Brad
years ago.
Pitt.
Brad Pitt, Leonardo DiCaprio, Margot Robbie, Damian Lewis, several other great actors, actresses in there. But Brad Pitt's character, I believe, was called Cliff Booth. And of course, Cliff Booth is a stunt double, isn't he? He's a stunt double for DiCaprio's character. And a reason I mention this, Jay, I wanted to ask you, why do you think I mention a stunt double? What's the connection here to investing? What do you reckon?
I'm curious. Where are you going with this?
Yeah,
Why are you
where am I
mentioning
going
a
to?
stunt double?
For me, because I just think so many investors need stunt doubles. So many investors don't behave the way they should do. They get scared. They watch the financial media. They listen to their friend next to the water cooler. Hey, this is a next great stock to buy. It's going to go up, 100% next 12 months. So I just think many investors need stunt doubles. And I actually think many investors could learn a great deal from reading, from taking on board mentors, and from taking on board the mistakes that other investors have made. So I want to circle back now to The Simple Path to Wealth, a great book written by J.L. Collins. And in this book, Collins writes about the mistake that he made as a result of Black Monday. Black Monday occurred in October, I want to say October 87, 89, and it was a massive one-day plunge. I want to say it was over 20%, freaked many investors out. And for J.L. Collins, it was too much. He's a powerful paragraph in here where he talks about it was just too much. I couldn't take it anymore. So he took his funds out, didn't invest anymore. And it's really humble. It's really humbling for him to write about that. And honestly, I really applaud, because he talks about the fact that that was a massive mistake, and readers, don't make the mistake that I made with that decision. So the point I want to make here about a stunt double is that, he no longer makes those mistakes, and we can learn through, writers such as J.L. Collins or Andrew Hallam, the success that Andrew Hallam has had in, investing in a philosophy defined by simplicity, investing in low fee index funds. We've spoken about the fact that Morgan Housel, Ben Carson, great book there, A Wealth of Common Sense. These guys recommend investing in a philosophy that's defined by simplicity. Okay, so for me, if you're someone that's relatively new to investing and you're enjoying our content, check out some of those books. I guarantee you have no affiliation. We don't receive commission for any of those books, but I know I've learned a great deal. And if people ask me, how did you come up with these 5 bedrock principles? Where do they come from? For me, it's a synthesis. That's one of the things I love about reading, whether it's investing books or not, but the ability to synthesize ideas from a range of texts. And it's through reading books, it's through talking to friends like you, through watching content online, that I was able to come up with that formation. And I want to actually circle back to simplicity for a moment. We've kind of gone full circle, but perhaps we can come back to Headstrong in a moment. But simplicity, there's a great quote in a book called Succeeding. I've got it in front of me, by John Reed. So the author is John Reed, and he states, when you first start to study a field, it seems like you have to memorize a zillion things. You don't. What you need is to identify the core principles that govern the field. The million things you thought you had to memorize are simply various combinations of the core principles. And I hope that's what my 5 bedrock principles do for investors, particularly beginner investors. They really help to simplify the investing process and to demystify. I think that's really key. Yeah.
Your listeners, they don't have to be reading the
No.
financials. They don't have to be looking at other recommendations from investment brokerages. With your investment strategy, it's easy, because they could just do the same thing over and over and over again, and without a whole lot of thought. It's stressful. As someone who used to follow the market really closely, it's stressful, man. I had to let it go because I thought, why am I watching it so closely when I'm going to get caught up in the hype and make me do something I don't want to do?
Exactly.
I had to ignore the headlines so I could remain in my desire to remain headstrong. I had to sort of turn off the noise.
Exactly. It's so important to do that. It's so important to do that. And you and I have interests outside of investing. I love reading. I love spending time with family. Likewise, you love reading. I know you like to go and socialize with the family, with friends.
And biking,
Yeah,
hockey.
exactly. Yeah. Every Christmas, Mrs. Sloth gets a list from me of books that I'd like. I mean, for example, I've got one right here, No Free Parking, about the history of London streets. And I know that if I spend hours and hours every evening looking at my portfolio, spending too long, I'm not going to get through my exhaustive list of books on my bookshelf. So that's a key point I'd make, particularly to beginning investors. With this style of investing, you don't need to spend more than an hour, 2 hours a year on investing. This is what this philosophy is all about. Less is more. Yeah, a year, exactly. It really is. It really is so critically important. So listeners, viewers, I hope we've done a good job there, Jay and I, of distilling the 5 bedrock principles of the Sloth Investor. I really hope we have. Jay, anything else you would add?
No, for people who might be tuning into because this YouTube channel is relatively new, if people want to follow you on Twitter, how do they do that?
So on Twitter, I am at Sloth_investor. I'd like to encourage listeners, if you're not subscribed as well, to please subscribe, because it helps to get this philosophy out to as many people as possible around the world. Since we've started to release more and more content on YouTube, I've seen a great increase in subscribers, but the more, the better. Okay, we want to see a real increase in the channel as well. You can also follow me on Substack, and in fact, for the description to this video, you'll see my link for Twitter, my link to Substack, and there'll also be a link there that will enable you to subscribe to the YouTube channel. Check out my content about book reviews. I've got several book reviews that I've recently released, particularly on the
those are great.
That's been one that's been really successful. And then just circling back to Headstrong, I've released around about, I think, 8 videos about cognitive biases, such as recency bias, action bias, in-group bias as well. So they're proving popular as well. So we're looking to release content more frequently in 2023. And I hope, Jay, that you and I can see a real increase in this understanding of the importance of investing like a sloth. Really do.
Right. And if you like today's video, folks, give it the thumbs up. Click on that thumbs up.
Absolutely. Yeah. Leave some comments, tell us what you think. Is there a particular bedrock principle that really resonates deeply with you? Love to hear your comments. All right, Jay, that was our first podcast episode of 2023, into our 3rd calendar year podcast. Looking good. Wow. Jay, I enjoyed it. I hope our viewers did as well. And I think we'll leave it there for now. Chinese New Year coming up.
Yeah, as we like to say here in Hong Kong, Kong Hei Fat Choi, everybody. Kong Hei Fat Choi.
Indeed. And we will see you soon. Okay. Thanks for tuning in. Bye for now, everyone. Bye for now.
Take care, everyone.
Take care.